Imagine this, waking up every month to see cash flowing into your account while you do, well, nothing. That's the beauty of a dividend portfolio. Whether the market's up or down, you're getting paid. Today, we're breaking down how to build a dividend portfolio that can generate reliable passive income month after month, year after year. We're talking about a portfolio that works for you, literally. If you want to stop trading your time for money and start getting paid to hold some of the strongest companies in the world, this video is for you. Over to you, DH.
Welcome back to the channel. If you're new here, I'm the Dividend Hero. Today, we're diving into one of the most powerful strategies for building wealth: dividend investing. Dividends are like the paycheck you get from companies just for owning their stock. But here's the key. If you set up a smart dividend portfolio, these payouts can become a consistent stream of income, a true game changer for financial independence. By the end of this video, you'll know how to pick the right stocks, how to balance risk, and most importantly, how to create a system that keeps paying you while you focus on living life. So grab a pen, take notes, and let's get started. Number 1, understanding dividends, the foundation of passive income. Let's start with the basics. What are dividends? Dividends are a portion of a company's earnings that are paid out to shareholders. Think of it like a thank you note from the company for holding onto their stock. The best part? You don't have to do anything. You get paid just for owning shares. There are two main types of dividend stocks you'll be looking at. 1, dividend growers. These are companies that not only pay dividends, but they consistently increase them over time. This means you're earning more and more every year just for holding. 2, high-yield stocks. These stocks offer a higher percentage of dividends relative to their price. They provide immediate income, but they may come with higher risk. Your goal is to build a portfolio that blends both of these, creating a stable stream of income that grows over time. Number 2, the power of reinvesting dividends. Accelerating growth. Here's the first major trick: reinvesting your dividends. Rather than spending that money right away, you can reinvest your dividends back into buying more shares. This means you'll own more stock, which means your next dividend payout will be bigger. Over time, this can create a snowball effect where your portfolio grows faster and faster. Let me break it down with an example. Say you own 100 shares of a company that pays $2 per share annually. You'll get $200 in dividends. Instead of pocketing the $200, you reinvest it. Now, if the stock price is $50, you've just bought 4 more shares. The next time dividends are paid, you're now getting paid on 104 shares, not 100. And the cycle keeps going. By reinvesting dividends, you're essentially accelerating your portfolio's growth without having to add more of your own money. Number 3, stock selection. Picking dividend champions. So how do you pick the right stocks for your dividend portfolio? Here's where we get into the fun part: research. There are a few things you want to look at when selecting dividend stocks. 1, dividend yield. This is the percentage of the stock price that's paid out in dividends. A stock with a 4% yield means for every $100 you invest, you get $4 annually. 2, payout ratio. This is the percentage of earnings the company pays out as dividends. A payout ratio over 80% might be risky because the company isn't leaving much to reinvest back into its business. Look for companies with a payout ratio between 40% and 60%. 3, dividend history. Look for companies that have a long track record of paying and increasing dividends. These are often called Dividend Aristocrats. Companies that have raised dividends for 25 consecutive years or more. They've proven time and time again that they can survive market downturns and still reward shareholders. You can find a link to my video about aristocrats in the top right corner. Some top examples of dividend aristocrats include Coca-Cola, Johnson & Johnson, and Procter & Gamble. These companies provide stability and consistent income growth. Number 4, diversifying your portfolio. Minimizing risk. One of the biggest mistakes new dividend investors make is putting all their money into a few high-yield stocks. While high yields are tempting, they often come with higher risk. That's why diversification is key. I go in-depth about high-yield traps in my video in the top right corner. But for now, let's talk about how to diversify your dividend portfolio. 1, Sectors. Spread your investments across different sectors like healthcare, utilities, consumer goods, and technology. This way, if one sector takes a hit, the others can help balance it out. 2. Geography. Don't just focus on U.S. companies. There are plenty of great international dividend stocks that can provide stability and growth. 3. Dividend types. Include both well-researched high-yield stocks for immediate income and dividend growth stocks for long-term gains. Think of it like this. A good dividend portfolio is like a balanced diet. You wouldn't eat just one type of food every day. And the same goes for investing. You want a mix to stay strong through the ups and downs. Number 5. ETFs and dividend funds. A simpler approach. If picking individual stocks sounds intimidating, don't worry. There's an easier way to get exposure to a wide range of dividend-paying companies. Dividend-focused ETFs or mutual funds. Dividend ETFs like Vanguard High Dividend, Yield ETF, VYM, or Schwab US Dividend Equity ETF, CHD, offer you instant diversification across hundreds of dividend stocks, and the fund managers take care of the stock selection. You still get that passive income, but without the hassle of picking and managing individual stocks. This can be a great option for beginners or for those who want a more hands-off approach to dividend investing. The best part? I do the heavy lifting for you by consistently uploading videos, researching hundreds and thousands of ETFs and funds. Talk about truly passive. Number 6. Building your portfolio. Step by step. Now that you know the basics, let's talk about how to actually build your dividend portfolio from scratch. It's easier than you think, and here's a simple strategy to follow. 1. Start small. You don't need a ton of money to begin. Start with what you can afford, whether that's $100 or $10,000. The key is to just get started. 2. Set goals. Are you looking for monthly income, long-term growth? Figure out what you want to achieve and structure your portfolio around that goal. 3. Pick 5 to 10 stocks or ETFs. Choose a mix of dividend growth stocks and high yielders to build a balanced portfolio. 4. Reinvest dividends automatically. Most brokerage platforms allow you to set this up with the click of a button. Turn on dividend reinvestment to get that snowball effect rolling. 5. Add regularly. Keep adding to your portfolio whenever you can, even if it's a small amount. Over time, these contributions add up significantly. 6. Monitor and adjust. Review your portfolio at least once a year. If a company stops paying or cuts its dividend, it might be time to find a replacement. Number 7. The long-term mindset. Patience pays off. Now for the most important part of dividend investing, patience. Dividend portfolios aren't about overnight success. They're about consistent long-term growth. The beauty of dividends is that they allow you to earn money while you wait for your portfolio to grow. Here's the payoff. After 10, 20, or 30 years of reinvesting dividends and letting your portfolio compound, you'll have a significant stream of passive income. Number 8. Tracking your progress. Staying on course. Now that you've built your dividend portfolio, how do you stay on track? Here's an important step. Tracking your progress. Dividend investing is a long-term strategy, so it's essential to review your portfolio periodically. You can do this every quarter or at least once a year. Use tracking tools like your brokerage platform or apps that help monitor dividends. Keep an eye on dividend growth. Are your dividends increasing year over year? Payout ratios. Is the company keeping a healthy balance between paying dividends and reinvesting in their business? Dividend cuts. If a company cuts or suspends dividends, it may be a red flag and could signal it's time to reconsider your investment in that stock. By tracking your portfolio regularly, you can make adjustments when necessary, adding new opportunities or cutting underperformers. This will ensure your portfolio stays optimized and on track to generate the passive income you're aiming for. After all, consistency and awareness are what keep a portfolio strong through any market condition. At some point, that dividend income can replace part or all of your job income. That's the ultimate goal of building a dividend portfolio, financial independence. Back to the studio.
And there you have it. your blueprint for building a powerful dividend portfolio that generates passive income. Whether you're just getting started or looking to optimize your strategy, dividends are one of the most reliable ways to grow your wealth over time. Remember, it's all about consistency. Start small, keep reinvesting, and watch your portfolio grow. Back to the studio. If you found value in this video, make sure to hit that subscribe button for more tips on dividend investing. And don't forget to like the video to let me know this is the kind of content you want more of. Drop a comment below and let me know, what's the first stock you're adding to your dividend portfolio? Until next time, keep building that passive income and let your money work for you.